Over the last 25 years, we've seen it all. The dot-com crash, the great financial crisis, a global pandemic, and the fastest rate hikes in modern history. Through it all, one asset class has proven resilient. In this video, we're breaking down how multifamily has performed through each of those market cycles and why it continues to stand out as one of the strongest long-term investments. Let's rewind to the late 1990s. The dot-com boom was in full swing. The stock market was surging, technology was driving optimism, and capital was flowing freely. In real estate, multifamily was considered stable, but not particularly flashy compared to office or tech-driven commercial assets. Then the bubble burst in 2000 through 2001. The recession hit, unemployment spiked, and the capital markets pulled back. But here's the interesting part. While office and retail properties struggled with high vacancies, multifamily actually held up relatively well. Why? Because during economic downturns, people tend to delay buying homes and instead choose to rent. This reinforced the view of multifamily as a defensive, income-producing asset class. By the early 2000s, interest rates were lowered to stimulate growth and liquidity flooded the market. Between 2002 and 2007, we saw one of the strongest housing booms in US history. Homeownership rates climbed, credit standards were loosened, and single-family construction soared. For multifamily, this period brought two dynamics. On one hand, some renters left apartments to buy homes, softening demand in certain markets, but on the other hand, easy credit and cheap debt fueled multifamily development and acquisitions. Investors increasingly saw multifamily as a reliable income play. This was also the era when institutional capital started paying more attention to apartments, recognizing the stability of rent collections compared to more volatile property types. Now let's move into the most significant downturn of the past 25 years, the global financial crisis of 2008. The housing bubble burst, Lehman Brothers collapsed, and credit markets froze. Foreclosures spiked, and the economy went through its deepest recession since the Great Depression. So how did multifamily perform? Initially, values fell and transaction volume slowed dramatically because debt was scarce. But compared to office, retail, and industrial, multifamily recovered faster. While retail struggled with bankruptcies and office demand collapsed, apartments benefited from millions of displaced homeowners who now needed to rent. Vacancy did rise in the short term, but by 2010, demand surged back. Investors who held through the downturn or acquired at distressed prices during those years saw some of the strongest returns of the decade. After the crisis, multifamily entered what many call a golden era. From 2011 through 2019, multifamily experienced almost uninterrupted growth. Millennials were entering the workforce, many of them burdened with student debt, delaying homeownership, and choosing to rent longer. Urbanization fueled demand for apartments in city centers, and institutional capital poured into the sector, pushing multifamily to become the largest segment of commercial real estate transactions. During this time, developers also ramped up construction, especially in the Class A luxury segment. That created some oversupply concerns in certain markets, but broadly speaking, the fundamentals were still strong. Investors who entered in the early part of this decade saw significant appreciation and income growth. Then came 2020. COVID-19 sent shockwaves through every corner of the economy. Many investors braced for the worst in multifamily. But what happened was surprising. While there was short-term pain in urban Class A markets like New York and San Francisco, overall rent collections remained much stronger than feared. Federal stimulus, eviction moratoriums, and strong demand in urban and Sunbelt markets cushioned the blow. In fact, by late 2020 and into 2021, multifamily became one of the biggest winners of the pandemic recovery. Work from home trends drove renters out of dense urban cores into suburban apartments. Migration to lower-cost, business-friendly states accelerated. And because interest rates were slashed to near zero, capital flooded into real estate. Multifamily valuations skyrocketed and transaction volume hit record highs in 2021. Of course, that surge didn't last forever. By 2022, inflation hit levels not seen in 40 years. To combat it, the Federal Reserve raised interest rates at the fastest pace in modern history. For multifamily, this was a turning point. Rising debt costs, squeezed deals, cap rates expanded, and transaction activity slowed sharply. Some markets that had seen double-digit rent growth in 2021 started to normalize. However, even during this adjustment, multifamily fundamentals remained relatively strong compared to office and retail. Vacancy rates rose slightly, but demand stayed resilient thanks to continued demographic drivers and limited affordability in the single-family housing market. Which brings us to today. As of 2025, interest rates have begun to stabilize. Inflation has cooled, and the multifamily market is finding its footing again. While valuations have adjusted from the 2021 peak, long-term fundamentals remain strong. The U.S. faces a structural housing shortage. Homeownership affordability is at multi-decade lows, and demographic trends continue to favor renting, especially among younger generations and downsizing baby boomers. So when we look back over the last 25 years, multifamily has consistently proven its resilience. Yes, there have been periods of adjustment and short-term pain, but over the long run, apartments have delivered strong, stable returns for investors who took a patient, disciplined approach. And that's the big takeaway. Multifamily is not just an investment in buildings, it's an investment in a fundamental human need, housing. That's why, through every cycle, this asset class continues to perform.